Okay, this is Nathan Smith, Resident Pacific University, degree completion. I'm continuing the slides from chapter 14. So let's talk about adjusting value for risk. Okay, we talked earlier about the value of a firm, talked about the idea of net present value. So this is the idea where you take profits in each period. The net just refers to your subtracting costs, but right now we just take this profit as given divided by 1 plus the interest rate to the power of t. So we correct for the fact that we would have been able to, present dollars are worth more than future dollars because you can invest them and earn interest in the meantime. So n is the number of periods, and profits divided by 1 plus the interest rate to the t. Okay, that's net present value. Well, risk doesn't appear in here. So we could say treat this as just a certain profit. That's what we've been doing before. But now we want to think about risk, so we want to take into account. Interpret this as an average profit at period t, and there's some risk attached to it. So this is kind of a crude mechanism for doing this, or somewhat simple. But the idea is you say, okay, if you have some kind of a utility function, you will discount future revenues more if they're risky. So we take K is a risk-adjusted discount rate, R plus some kind of a risk premium. And so then we use the same net present value formula, except that we put K in instead of R. Since K is going to be higher than R, that's going to mean the value of the firm will be lower. That's to take into account the fact that it's risky. Obviously, everything depends on this risk premium. How do you pick the risk premium? Well, there's no real scientific way to do it. It would just be some kind of a decision. You say, well, okay, it's like we would need a 9%. We'd need a 9% interest rate to compensate for that kind of risk. Maybe 6% is the going interest rate, but that's 6% if you were to invest it at a risk-free rate. But in practice, if you were going to invest in a way that has all this risk attached to it, you would demand a higher premium. Maybe K, maybe 9% would be that. So then you would calculate the net present value accordingly. So this is one way to adjust for risk. So risk here, this is standard deviation. We say the higher risk is, the lower, the higher the rate of return that we would need in order to compensate us for that. So this is sort of an indifference curve, meaning that each point on here, the manager's indifference between all these B, D, C, and D. So what does it mean that they're indifferent? So B, that's a project with a 14% rate of return. Standard deviation is 0.5. So if you have a project with a 20% return, standard deviation of 1, in this case the manager values that equally. If it's D, 32% risk of 1.5, that'd be the same. Now, you can think about what this curve would be shaped like for different kinds of managers. If you're risk neutral, then it would just be a straight line because you wouldn't need to be compensated for taking on more risk. If you're risk loving, it would actually fall. But so R prime and R double prime are all risk averse, but they're risk averse in different degrees. So so the very risk averse manager is here at R prime, more risk averse than for R. A less risk averse manager would be this one, R double prime. So these curves in rate of return risk space represent different preferences over risk, different degrees of risk aversion. Okay, so here's another approach. In this case, you say, okay, we've got some kind of expected return in the future, we call it RT, but it's risky. And so we have another way of compensating for that, and here we say, okay, to have this risky approach, this is less because it's worth less because it's risky than it would be if it were certain. So how much would I have to discount to be willing to take the certain payment over this risky payment? Well, we call that alpha. So alpha is the equivalent certain sum over an expected risky sum. Certain sum marked with R star. It's basically how much is this prospect of future income reduced because it's risky relative to if you had a certain return. And then you just discount all of those by the interest rate. So this is a slightly different approach to valuing risk. And which one is correct? I mean, there's not really a perfectly definite answer to this, but you'd be better off doing either of these. What would be very naive would be to just ignore the risk and treat it as if the net present value were for a risk-free stream of incomes, when really what you're dealing with is, if you were to just calculate the average risk, or the average return, and then calculate the net present value on that basis, when this is risky, that probably wouldn't be a very good basis for decisions because probably you're somewhat risk-averse. Okay, so we can look at decision trees as well. So simulations, that one gets really complicated. That's one where you'd probably hire outside consultants to do that. Be much more expensive. That's where you would allow lots of possible variables to vary, and this might be more continuous. Simulations could do a lot of different things, but this might be more for continuous. For decision trees, I've got an example here. So you've got a company that can pick a high price or a low price. They've got competitors who could pick a high price or a low price, and then the economy has different possible states. So there's lots of things that could happen. Now, the manager only makes one decision. The manager can't control how competitors react, can't control the state of the economy. So he just picks a high price or a low price, and then the rest of it all plays out. But he can think about, and the profits, they depend not only on his decision, but also on these other things that he can't see, like what the competitor's reaction is going to be and what the state of the economy is going to be. Now let's take a look at these probabilities more closely. If he charges a high price, he thinks there's a 60% chance that competitors will charge a high price, 40% chance they'll charge a low price. If he charges a low price, he thinks there's a 20% chance his competitors will charge a high price, an 80% chance they'll charge a low price. So you notice these probabilities are affected by the manager's decision. Competitors are likely to imitate a low price if he charges one, and likely to imitate the high price too if he charges one of those. So he can affect his competitor's behavior by his choice, or at least affect the probability of, of his competitor's behavior. Okay, now let's look at the state of the economy. 30%, 50%, 20%, 30%, 50%, 20%, 30%, 50%, 20%, 30%, 50%, 20%. Doesn't depend on either the manager's decision or the competitor's decision, and that makes sense. Both the manager and the competitors are too small to influence the economy as a whole. There's probably going to be one industry, and probably even one industry in one particular local area. The economy as a whole is not going to be affected by that decision. So now we can figure out all these probabilities. Now you notice 1 through 6, these all add up to 1. Specifically, we get them from 0.6 times 0.3, 0.18, 0.6 times 0.5, 0.3, 0.6 times 0.2, 0.12, 0.4 times 0.3, 0.12, 0.4 times 0.5, 0.2, etc. And all these would add up to 1. So this is, let's see, 18, 48, 60, 72, 92, 1. So these all add up to 1. So these mean there's no probabilities attached here because this is his decision. He's not thinking about probabilities here. It's up to him. But after that, he wants to take into account the probability of lots of different events happening. Now, he has guesses about what his profits are going to be under these different circumstances. So, for example, if he charges a high price and his competitors charge a high price and there's an economic boom, that's a pretty good situation, then he's expecting to make 60,000. If he charges a higher price, his competitors charge a low price, and the economy's normal, then he'll make somewhat less, like 30,000. So we have a whole list of outcomes. We multiply them all by the probabilities, and then we add them up. We get the weighted average, and it's 38,800. That's the profits that he expects to make, taking into account all the probabilities. It's the average expected profit if he charges the high price. If he charges the low price, then you have these different probabilities. So 20% times 30%, 0.06, so 6%. And you notice that his profits are lower in this case, 50,000, than they would be under the boom. So but in other cases, he actually does better charging a low price. So in this case, if there's a recession and he and his competitors both charge a low price, then he'll make 25,000 in this case, 20,000 in that case. In a recession, people may not have that much money to spend, so then he really has to be underselling people, and if he doesn't choose his prices in the right way, then he'll make, if he's charging a high price, he'll make less money in this case. In fact, I guess in this case, 35,000 versus 50,000. So in that case, he's better off charging a high price, even if his competitors are underselling him in the boom. A recession, again, he makes more profits here. Low price, high price, recession, 25,000, 20,000. So in a recession, it's advantageous to charge a low price because people are really going to be looking for deals. So, and then normal, it looks like he's actually making the same. So, in the recession and the boom. So, okay, we add these up, get 32,400. So he's better off charging a high price. And the main reason for that, if you look back at these probabilities, is that if he charges the low price, his competitors are probably going to follow suit. And it's always bad for him. He always makes less money down in this quadrant than he does up in this quadrant. He's definitely better off if his competitors are charging a high price, and they're more likely to do that if he charges a high price. So his best strategy is to charge a high price. We can work back. Well, I mean, so this 32,400 goes here. This 38,800 goes here. He's better off charging a high price, and it's almost like a kind of a tacit collusion in this case. But using a decision tree model to decide what the best strategy is. And notice we haven't actually taken account of risk in this case. We're just calculating the expected profits. Okay, this is an important, rather counterintuitive point. Suppose you've got a risky asset. You've got a less risky asset down here, a more risky asset over here. You can see this on, you've got rate of return, risk. Asset E, asset F. Asset E is less risky than asset F, but it also has a lower rate of return. Now, you might think that if you buy a portfolio that blends asset E and asset F, you get some of both. You might expect that it would be aligned through the two of them. That's not the case, because if asset E and asset F move sort of independently of each other, their movements will offset each other. So that if asset E is doing well, asset F may be doing badly. Not necessarily, maybe they both do badly, but there's at least a reasonable chance that asset E does well, asset F does badly, and so then those offset each other, and so that actually reduces your risk. When you have asset E, if you have all asset E and then you start buying some of asset S, you actually reduce your risk initially, even though you're buying a riskier asset, because the riskier asset has movements that are uncorrelated. You're diversifying, and that reduces your risk. But eventually, as you accumulate more F, then your portfolio also starts to become riskier. So it curls around like that. Now, if you have these kind of risk-averse preferences, the point of tangency, this represents the highest indifference curve that you can get on. C represents the best point you can be on. There would presumably be more indifference curves further down along this chart, but those would represent either lower rates of return or higher risk. You want to be as close to this corner, to this upper left corner as you can, and C is as close as you can get. So that's a story about portfolio choice. This shows in practice in the I think 1984 to 1994. Foreign stocks tended to have higher returns than U.S. stocks, but they were also riskier, higher volatility. So what portfolio should we pick? You definitely don't want 100% U.S. That's not going to make any sense because foreign stocks tend to move differently than U.S. stocks do. So if you're diversified, then you can actually initially reduce your risk too, because if something bad happens to the U.S. economy, then your foreign stocks are likely to hold up. So, of course, if something bad happens to foreign stocks, your U.S. assets are likely to hold up. So the two kind of offset each other and reduce your risk. As you make your asset more and more dominated by foreign stocks, well then, you're starting to accumulate a lot more risk. Because at this point, if you're starting at all foreign, you move a little bit in this direction, adding U.S. stocks. Well, those U.S. stocks, not only are they less risky in themselves, but their fluctuations, their volatility is also uncorrelated with that of foreign stocks, or probably less correlated with it, and so you reduces your risk in both ways. Okay, now we'll talk a little bit about uncertainty. Of course, in a sense, it's harder to be rational when you're facing uncertainty because you don't know the probabilities of different outcomes. So I'm just going to throw out a couple of sort of crude criteria. One would be the max-min criterion. This is where you say, okay, you've got various outcomes that are associated with each strategy that you can pursue could lead to multiple outcomes. It depends on some kind of outside factors that you don't know. So in the max and min case, you just say, okay, which strategy has the best worst case? Just compare the worst outcomes and the one that yields the best worst outcome. Sort of minimizes the, it maximizes the minimum. That's what this term max and min comes from, maximizing the minimum. And now that might be kind of stupid if, let's say, I have various strategies and one of them can earn me $10,000, but it might lower my wealth by 100 with a very small probability, and another one would only earn me $1,000, but it has no chance of lowering my wealth. Well, probably it's worth risking the very unlikely $100 loss to increase my returns by 10,000. But the whole point with max and min, you've got uncertainty. You don't really know what the probabilities are, so you can't take that into account in your decision. So this would be one decision rule that you could adopt. So in this case, we say state of nature. You could succeed, you could fail. You've got two strategies. You could invest, you could not invest. Don't invest, you get 0, 0. Invest, you get 20,000, negative 10,000. So if you want to play a max and min strategy, then you would go for the 0. You wouldn't invest. And you notice that what we don't have in this chart doesn't say anything about the probability of success or failure happening. Obviously, you would want to know that. That would help your decision. But sometimes you just don't really know that. So this is what you would happen if you followed the max and min rule. Another possibility called Minimax regret. It's kind of subtle, but here what you do is you construct a regret matrix. So this is the maximum that you can lose by having chosen what you do choose relative to something else. So in this case, the payoffs are the same as before. The regret matrix here, 20,000 are your regret, so you didn't invest, but it would have been successful. So 20,000 is the gap there. In this case, If it's a failure, well, you could have avoided the loss of money, so it's 10,000 is a measure of your regret. So if you want to minimize the maximum possible regret, then you actually would want to invest in this case, because then the maximum regret you could suffer would be 10,000. Here you might suffer 20,000. So this is a different strategy. And again, we don't know anything about the probabilities of these taking place. That's why it's a minimax. That's why we're using these sort of crude methods, because we can't do more sophisticated things without the probabilities. Okay, under uncertainty, you're likely to try to gather additional information. You might request the opinion of authority. You might do something to try to control the business environment. You might try to diversify. You might do. These are just a lot of different things you might do to avoid being exposed to this uncertainty. Okay, so some risk is associated with foreign exchange. And in this case, particularly if you're in a business where, say you're in a business where you often have to deal in foreign currencies, you often know that bills are going to come due in foreign currencies or that you're going to receive income in foreign currencies. You don't know how that's going to change. A lot of times you might want to get rid of the foreign exchange risk because your business is not speculating on the value of foreign currency. It's something else, and if you can get rid of that risk, then you can focus on your core area. So you can do this by hedging. Try to cover your foreign exchange risk. This will involve using some kind of a forward contract. So that means you sign the contract today, but it gets executed at some point in the future, but the terms of the contract are chosen today. One version of this is a forward contract. So this is an agreement. Purchase or sell a specific amount of a foreign currency at a rate specified today for delivery at a specified future date. If you know you're going to need a certain amount of currency at a certain time, you could take out a forward contract. Then you can lock in some kind of an exchange rate. Futures contract is similar, but it's a more standardized type of contract, and it's more liquid, meaning that futures contracts you can buy and sell these. Forward contracts, they're just between two people. There aren't liquid markets for these kinds of things. In fact, it might not even be written to the contract that you have this option. Futures contracts, you can do that, so that's a way you can eliminate your foreign exchange risk or reduce your foreign exchange risk, depending on the situation. One tricky issue is that sometimes. Risk involves not knowing something. It involves not knowing what's going to happen in the future. So in a sense, risk is about information. But what can sometimes happen is that you may not have the information. So something may look risky to you. Somebody else may have more information than you do. You can have asymmetric information. So one party has less information than the other about something. For example, about the quality of a good. So adverse selection can arise in this case. And this would be a good example is used car markets. So if someone's selling a used car, well, they know a lot more about the quality of the car than you do. And so probably, if they have a great car, if they have a good used car, they're probably not going to sell it. Probably only going to sell it if it's not as good as it looks. But because you know that, you won't pay as much as it looks like it's worth to you, because you know that there's this adverse selection problem, and so then you get a situation where low quality goods drive high quality goods out of the market. I think this may be less of a problem than it used to be, because of Carfax and all these sort of services for verifying the quality of cars. But anyway, moral hazard, adverse selection and moral hazard are the two cases here. Adverse selection means that because of asymmetric information, then the types of people who enter the market on one side are less advantageous to do business with. moral hazard is if the people who enter the market behave in different ways. And the famous example, the simplest example to think of is somebody who takes out fire insurance and then burns down the building in order to get the insurance payment. I mean, most cases of moral hazard are not as criminal as that. It might be more. I remember one time I went on a skiing trip, but I didn't have health insurance at the time, so I didn't really take any risks. I was a lot more cautious than I would have been. Well, if I'd had health insurance and I figured that, well, the insurance company will just cover it if I injure myself, I might have taken a lot more risk. And that's not very good for the insurance company. So that would be a case of moral hazard, where since I know that I'm not going to incur the cost of whatever injuries I take myself, or at least I'll incur the pain or whatever, but some of the treatment would be covered by somebody else. That could be an example of moral hazard. This is all over the place. There's lots of moral hazard. The bailouts that the government did in 2008, one issue is they might have created a lot of moral hazard. Maybe companies are now saying, okay, well, let's take a lot of risk. If they go badly, the taxpayer bails out. If they go well, we'll look like geniuses and we'll become super rich. So how do you control that? It's a big challenge. But typically, contracts will specify precautions. You can only get insurance if you take certain precautions, and you probably can't fully insure a lot of risks. Maybe people who, if there wasn't a moral hazard problem, they might be willing to fully insure your risk. They might be happy to do that, and you'd be happy to get rid of the risk. But they can't do that without reducing your incentive to avoid the loss. So. This is an example of a principal-agent problem. So speaking more generally of principal-agent problems, so in the corporation there's sort of a systematic conflict of interest between managers and owners. And what often happens is that sometimes managers are more risk-averse than owners are. Shareholders tend not to be very risk-averse because they usually own lots of different shares. They're well diversified, so they just want you to maximize the expected return. They don't really care about the risk. Whereas managers, they might have a lot more tied up in the company. It can really hurt their careers if they take a risk that goes badly, so they might be much more risk-averse. Or they might have other incentives. Maybe they're just lazy. They just don't want to work very hard. Or maybe they want to come across as a nice guy by pleasing the union, even though that's not in the interest of the corporation. There could be lots of other interests that managers would have. So one of the problems when you hire a manager is to try to get the incentives right, so that what he wants to do is the same as what's in the interest of the corporation. Now there are actually limits to this. I think, and sometimes maybe what's really most valuable is you just have a manager who feels that his job is to run the company well, and he's not always thinking about his own interest. There's lots of ways that these attempts to align the manager's interest with that of the corporation, with that of the shareholders, can backfire, but at least if you do want to do this, one example would be things like stock options. So that links the compensation of the manager to the performance of the firm. And golden parachutes, these get a lot of bad press. But if you're taking over a company, sometimes you give the current managers golden parachutes. You give them really generous retirement packages, because otherwise then they'll use their influence in the company to prevent a merger, for example, to prevent some desirable change. So they have to be kind of bought off. And this can also be a way of trying to get them to take risk. If you tell the manager, okay, if you take a risk and things go badly, then we'll fire you, but we'll fire you with a golden parachute. And then the manager starts to become willing to take more risks, which is what the shareholders want. But, of course, this could create moral hazard, too. So it's actually really hard to solve this problem. Okay, another sort of example of imperfect information, uncertainty, is auctions. In auctions, there's some uncertainty about the value of something that's being sold. This uncertainty can take a lot of different forms. And so people have designed a lot of different types of auctions to try to to make the most money out of it while also evoking information. So an English auction is an example where it's a sequential ascending bid auction. You start with a low bid, and then people outbid each other until eventually the highest bidder wins the auction and gets to buy whatever is being sold. In a first price sealed bid auction, this is where everybody says what they're willing to pay, puts it in an envelope, submits it, and then whichever price is the highest, that person gets to buy the good. A second price sealed bid auction, this is kind of a clever design. This is where everybody submits what they're willing to pay, and then the person with the highest bid gets to buy it, but they only have to pay the second price. You say, well, why would you do this? The person said they're willing to pay this higher price. Why would you tell them that they only have to pay some other lower price? Well, in the first price auction, people want to make money off it, so it's not in their interest to bid what they think it's really worth. Second price auction, then if you've bid really high, if you bid a lot higher than the next bid, that's fine because you only pay the next bid anyway. So it actually gives people an incentive to bid what their true value is. Dutch auction is another format where you call it declining prices, and then the first time, as soon as someone agrees to buy, then the item is sold. And there's a lot of theory about when these different kinds of auctions are most efficient and what the advantages and disadvantages of each kind are. We won't go into all the details, but one thing that's important to think about is this idea of the winner's curse. The winner's curse is where the person who wins the auction probably overvalues the good. So if everybody's value can be a little bit off in either direction, some people are overestimating it, some people are underestimating it, well, the people who are underestimating it are not likely to win the auction. They're probably going to bid low. Probably going to be someone who overestimates the value. Of course, the item may have different values to different people, but some people may overestimate what the item's really worth to them, and so that's called the winner's curse. And this is something that it's important to bear in mind in any situation where you're bidding on things, where you're competing in an auction. Well, guess what? If you're somewhat off, if you're underestimating, you'll lose the auction. If you're overestimating, you'll win the auction, but you may regret that you did, because then you have to pay a lot, and it may turn out that the item isn't worth as much as you did. And the fact that you won is going to be evidence that you didn't. You could be like, oh, I bid such and such, and I won the auction. Like, because that means that nobody else thought it was worth this much. What do they know that I don't? So different kinds of auctions can cause this more than, I guess Dutch auctions do more than often than English auctions. You can kind of imagine how with English auctions you might sort of take your cue. You're watching what other people bid. You've got some kind of a clue about what it's worth to other people. But, okay, well, that's chapter 14.